and I work for First Bank. I've been with First Bank for 5 years, and I've been in the industry for about 10. And if you guys, ZZ's over here.
Yeah, my name is Zizi. I work here downtown with Ruben. I've been with the bank for just over 3 years now, and I was a first-generation student at CSU back when I was there. I graduated in 2017.
Oh yeah, I am also a RAM and graduated in 05, so just a little before ZZ and Sam. But so we're gonna start by, we're just gonna go through the process from beginning to end. Like I said, we're gonna be 20,000 foot view on a couple things and digging on a couple of things a little deeper, what we feel where our expertise lies. But one thing to note, and I want to let everybody know that everybody's financial journey is different. I, as a 30-year-old now, I guess I was 37 when I bought my first house. And so I was very proud of that. And it took a long time for me to get to where I was at. ZZ, proud of him. He bought his first and has also an investment property in the last 3 years. So everybody's is totally different. No judging whatsoever, because everybody's situation is different. But we're going to start with our first part of financial literacy. I guess that's the first part of this journey to owning a home. And it's not just owning a home, but it's also getting a car loan or any other type of loan that you may need. So the first thing, I mean, as a young adult or even younger, I would have people establish a bank account. And that's really the biggest part, is trusting banks, knowing that they're going to keep your money safe. I know a lot of folks that have ITIN status or come from a different country are afraid of banks because of their situation in their countries before. So banks are good here in the US. Your money's insured up to $250,000. So I would recommend establishing a bank account and being responsible with that account. Sure, banks might let you overdraft every once in a while, but keep in mind that's money you owe back to the bank, and that will follow you to any bank that you go to. So after you establish your bank account, I would highly recommend making a budget. And ZZ is an expert at creating his own. Well, his budget is very meticulous down to the penny, where my budget is very broad, and not as a complex spreadsheet, but everybody should have a budget. And I'll pass that on to ZZ to talk about his.
Yeah, so just speaking about a budget, like Ruben mentioned, everybody's kind of financial plan and just finances in general is independent and subject to the person that they are and that they do. And so when you create a budget, you want to kind of just make it attainable for yourself, setting reasonable expectations and finding that bottom line without stretching yourself too far. So I thought I'd give an example of kind of how I budget my finances, and that's kind of just a simple income and expense tracking sheet, to where I know how much I'm getting paid from my job. I know how much money I'm getting from other sources of income, such as rentals and so forth. And then I go down the list of tracking my expenses. You know, I add in my cell phone bill each month, my car loan, if that's there, credit card payments. I put down the amount of groceries I'm going to spend, gasoline, a random category that gives me like about $200 or so a month to go out and have fun with, or if I go out and eat or something like that, I have a category for that. I have a category for my dog, so that way I know that I need to feed my boy Roman, and so he can eat, and that's not taken away from my bottom line. Once you establish all of those expenses, then you kind of set, and you get your what's called your net income there for your personal income, and then you draft out of that into a savings account a certain percentage. I like to tell people at least 75% of that, if not more, just depending on what you're capable of doing. And that will allow you to put that money into another account called a savings account, rather than your checking account, which you use as your daily kind of cash expenses. And so that by giving yourself that budget of 75% of that bottom line number at a minimum, after all your expenses is taken out, that gives you a nice cushion to where if something does come up or some problem does arise, you have enough funds within your checking account to not have to dip into your savings account. You want to make that savings account kind of as separated as possible, and not having to dig in and out of that to kind of set yourself up for whatever kind of purchase you're doing, whether it's for a home, whether it's for your school, whether, you know, or maybe a car. And so just, you want to keep those two separated to identify where you're at. And by having this kind of tracking mechanism, it allows you to project when you're going to, you know, make that purchase of your first home, in this case, since that's what we're speaking about. It'll allow you to know how much you're going to have available to put down on the property at a certain given time. And so then tracking from there, once you establish your budget, you want to kind of start establishing credit. You know, that can be with your bank account holder, which is a bank. So we both work at First Bank. If you were to establish a bank account here, you may get, you know, cross-sold a credit card or some sort of credit line elsewhere, such as in-store credit cards. I think everybody has been offered that at some point. Establishing those credits is very important because you kind of build yourself up to be viewed as trustworthy, to be viewed as reliable, and that's what kind of starts to build your credit history. And so I'll let Ruben start talking about what credit history is and what it kind of entails along with your credit score.
Yeah, thanks, ZZ. So when you establish credit, I mean, credit cards aren't bad. People say are very debt adverse, and that's not the case. I mean, as long as you use it responsibly. I know when I was in college, I was getting offers for credit cards daily, and I shied away from those, which is a good thing. But it's always good to have credit, and the best way to start credit is probably with a department store credit card, or such as Best Buy or Banana Republic or whatnot, just so you could make your purchases and turn around and pay those off. You're not incurring or paying any interest on those. However, you are starting to establish credit. What that means is it's a history of every trade line that you have. A trade line is any credit limit, any car loan, any student loan that you may have is considered a trade line. And so by establishing that and having a, I guess, good history of it, that starts building on itself, where creditors look at, yes, they have access to X amount of dollars. They've used so much of it and they've paid it off on time. And that's what's going to be increasing your credit score as you go on. Credit scores range from probably 450 to about 850. To be a candidate for a loan, you want to be probably above 600. And that way, as you get older and are further along your financial journey, your credit will increase just by the amount of loans and payments that you've made on time. And that's really essentially the first part of attaining a loan is a credit history. Before we get into down payments, I mean, does anybody have any questions on the financial literacy part or budgeting?
Did you ask if there's any questions?
Yes.
Sorry.
Any questions
Okay.
on the first part, what we've gone over? Sorry.
No, that's great. We do have one question. It's actually from me, because we had a workshop recently where someone was like, don't get store credit cards. And so I was just wondering if you could talk a little bit more about that and maybe why it could be good. I mean, that's how I established credit, was from I think it was like Old Navy and Macy's. But I don't know, I've just heard a lot of different things about getting a store credit card and versus like not. And then we have another question too that I'll ask in a second.
Yep. So I'll let ZZ talk on this first, but
Yeah, so the reason why we mention kind of in-store credit cards or department store trade lines is the fact that obtaining a credit card through a bank can kind of be difficult at times, especially if you're beginning to establish your credit history. I know here at First Bank, we like to see kind of 3 different active trade lines, and we look at that kind of history to see if there's any late pays, any delinquent accounts, which means that you have an outstanding balance that's been sitting there 30, 60, 90 day plus. And so it's a lot easier for you to obtain a in-store credit card, regardless of kind of your situation. All you do at the counter when you're about to go pay for your clothes is they say, "Hey, would you like to check out our, our in-store credit card options?" And you say, "Oh yeah, let me take a look at them." You put in your income that you get, and then it will automatically approve you on the spot there, or maybe decline you. It depends on kind of where you're looking at. It does a kind of a quick pull of your credit. I don't believe they go through your full credit history, anything like that, but you get a small kind of in-store line, and you can make your purchases off of that and then turn around and pay them with the amount of money that you were going to be spending on those clothes anyways from your checking account. And so that starts to build your first history with your or your first kind of marks on your credit history report. And so I think that that's why it could be very beneficial to people who have applied to get a credit card and have been denied. I know when I first started trying to get credit, I tried to go through Chase Bank, and they denied me twice because they said I didn't have enough credit history. And so I was like, well, how do I get credit history if you're not going to give me credit,
Right,
And so
exactly.
it was kind of a circle. And then I found out that, hey, I can go into Macy's or I can go into Target or whatever and apply for an in-store credit card. They're more, they're more willing to take on that added risk to people when small amounts of credit lines, and that's all you really need. And so you get those, and then you pay it back right away, and then you go back again and do the same thing over and over again, and your credit score is going to start to pick up, and then you can start to merge off into the banks and establish a credit card with a financial institution.
I see. That's
Yeah, I would
really
say the
good
same thing. It's just
information.
easier to obtain a department store credit card.
Mm-hmm.
And what was the other
Yeah.
question? I think I saw one pop up too. Or somebody had a great suggestion of using Mint, the app. Is that right?
Yes, that was the other one.
Yeah, then that's actually really good because that ties into directly to all your accounts. So what that does, I've had Mint before where you put in your credit cards, your bank accounts, and it keeps track of how much you're spending, how much you're paying down, and you could set multiple goals on there. So that's a great suggestion, whoever suggested that.
Cool.
Any other questions?
Does renting count towards credit?
So yeah, it may. So not many landlords report credit. There are some that do report to the credit agencies. Most of them don't. But it does count as a trade line if the bank needs to verify your payment history with the landlord. If the landlord drafts up a letter stating that you have been there for X amount of months or years and have been paying on time, that won't affect your credit score, but it'll be considered as a trade line to the bank.
I'd also add that you can ask your landlord to report it to your credit. That is definitely okay to do. It is up to them to kind of approve that request. I think it does cost the landlord. There is a small fee with reporting to the credit agencies. And so that fee may come back onto you, or maybe they already have an established way of doing that. And then they can just add your name on that list that they send in. So it is a request that you can do, and it will help your credit history. And so if that's something that somebody's looking for, then the first stop would be to discuss that with your landlord.
Cool. Thank you.
You can also do that with utilities. Utilities isn't reported on your credit report unless you just have delinquent utilities and haven't been paying them for a while. Then they will go onto your credit report as a negative impact. However, you can request that the utility company track your credit history on your credit report as well.
Okay, that's so cool. Thank you.
Cool. So if we don't have any more questions, we're going to go to the next part, talking about loans specifically. After you created your budget and however months or years it's taken you to save up, you have to think about the down payment the down payment that you're going to be looking to purchase a home. Down payments could vary from anywhere as little as 3%. And I say as little, but I mean, at 500,000, 3% is still a lot of money. But just the Denver market's pretty crazy. But anywhere from 3% to 20 or 25%, depending on the situation. Anything that you put down less than 20%, you are subject to pay PMI, which is private mortgage insurance, or MIP, mortgage insurance premium, if you go through the FHA route. So that's just a payment to an insurance company's third party not associated with the bank. In case you go into default, that insurance company covers a certain percentage for the bank if they do have to foreclose on the house. But that's not a bad thing just to get into the house too, but eventually you want to get that PMI off, just because that's an added expense that you're not building any equity towards that house. But I'll let ZZ talk about the couple different most common down payment options, and we'll start, I guess, with the 3%.
Yeah, and before I jump into that, just what Ruben was discussing with PMI or private mortgage insurance, that does play a factor with your credit report as well. And so your credit score kind of determines the amount of mortgage insurance that you would be required to have, depending on the different insurance company that's protecting that. So the most common is the private mortgage insurance that's offered through kind of Fannie and Freddie loans, which is kind of a secondary market style loan, and they do a different source of underwriting than what the banks do. And then the other option was that MIP option, which is mortgage interest premiums. Thank you. Mortgage interest premiums, which is involved with if you have an FHA loan, which is FHA stands for the Federal Housing Administration, and that is kind of a different underwriting guidelines, a little bit more feasible to get into homes and so forth. And so we'll kind of talk about a couple different options with the loan structures associated with it. The piece where Ruben brings 3% down. So you can bring as a borrower as little as 3% down with a minimum amount of $1,000 for most banks. And that 3% down is eligible to people who have legal status as well as DACA. And so DACA borrowers can obtain a PMI loan and put down as little as 3% down, and then be subject to that mortgage insurance for the rest of that 17%. And so that down payment can be comprised of multiple different things. It can be comprised of money that you've earned yourself through your job. It can be comprised of down payment assistance programs that are available and out there. And it also can be comprised of gift funds. Gift funds are something that your parents can give you, and they write a letter saying, hey, I am giving, Tom this money as a gift with no repayment terms associated with it. It's truly a gift, and that goes into a whole different tax thing for the gifter that we won't get into today. But that is an option to do as well. It does have to come from a family member, and most of the time a parental or guardian figure. And so that 3% down would be the minimum there. The minimum on an FHA loan is 3.5%. So it is a little bit higher than the conventional PMI route. And so it's the same thing. You can get those funds from all those three sources that I mentioned in the first time. The second kind of down payment that you would need is a 20% down payment. And that's going to be if you're ever purchasing a rental property, or if you are a DACA recipient and you are signing on the loan with a parent or another person who has an I-10 or who is an I-10 borrower, and you would need to be 20% down. If it's just an I-10 borrower, you're able to do the loan as well. And this is by case scenario, depending on which financial institution you go through, brokerages and so forth. You would need 25% down at a minimum if you're just an I-10 borrower with nobody that has DACA or has completely legal status here in the U.S. And so those are kind of the three or four main kind of down payments. Of course, you can put 5% down, you can put 7, 8, 9, all the way up to that 20% mark and still have PMI on it. But those are the most common thresholds that you see, is that 3% or 3.5%, and then that 20 or 25. So yeah, that's kind of a large kind of discussion item. So we'd like to just open it up for kind of questions and answers to kind of go over those pieces there.
The one thing I like, before we go to questions, I like to add, when you're making your budget and you're shooting for that 5%, so you say you chose 5%, you feel that's attainable in a couple of years for a down payment, you go buy in a house. Keep in mind, there are charges and costs for a loan. So on top of the 5%, you're going to have to come up with maybe a ballpark $6,000 extra for closing costs and what they call our escrows, which are your taxes and insurance premiums. The bank will have an account established for you. So every time you pay monthly, it fills that bucket, so to speak, and the bank will make those payments on your behalf on time when those are due. So that's something to keep in mind when you're saving up to buy a home. There are added expenses, and not to mention, I mean, as you get into when you buy your home, there's going to be a little bit of furniture you have to purchase, your utilities, and some of them might need deposits if you don't have any credit history. So have some cushion, and don't, if you're going to strive for that 5%, keep in mind you're going to need a little bit more because of additional fees and costs. But we'll open it up for questions there.
I don't see questions in the chat at the moment, but if anyone wants to unmute, you didn't get to write your question in the chat, you can. I put a question in the chat because I was wondering, you said something about second market with people who can give you loans, and I was just wondering, are those like less safe than banks?
No, that's a good question. So in the mortgage world, there's what's called, you'll hear portfolio loans, and those are loans that the bank themselves keep on their books for the length of the loan. And then you'll also hear secondary market / agency loans, where that's more of your brokers, and depending on the loan product at each financial institution or bank, they'll sell those in the secondary market or to the agencies. So that's what those are. All the brokerages sell those loans, and what happens, I mean, if you're taking your finance classes, those are the loans that they talk about bundling them up and selling them to mortgage-backed securities on a bigger level. So those are loans that are sold off to investors. But usually they're the same terms. The one thing that would change is probably your servicer, where you make your payment to each month. But none of the terms would change. If you got a 30-year fix at 3.5%, that's good for the life of the loan.
Oh, okay, I see. Thank you.
Cool. So we don't have any questions on down payment. We're going to go to the actual loan process, where ZZ and I feel we're the experts. I don't know if our colleagues will tell you that, but we are the experts on loans, and we'll go from. We do have a question. 15-year and 30-year loan, is that right? So there are fixed rate loans, and there are what's called ARMs, so adjustable rate mortgages. So a 15-year fixed and a 30-year fixed loan is simply what it is. So it's a 30-year loan or a 15-year loan with a fixed rate that cannot change for the entire length of the process. On a 30-year loan, if you make the minimum principal and interest payment each month at month 360, that 30 years, you'll have a zero balance. So every payment that you go towards interest and principal, and after 30 years, you'll have zero. A 15-year, your rate's higher, but obviously you're paying less interest to the bank because you'll be paying that loan off in 15 years. Now, the other loans, which are ARMs, you could have 1, 5, 7, 10-year ARMs. And what that is, for example, let's just take a 5-year ARM as an example. That rate will generally be better than a 30-year fixed rate, because in 5 years, it's still a 30-year loan, but in 5 years, that loan may or may not adjust and each year after that. So say you start, the 30-year fix is at 3.5%, the 5-year could be at 2.75, but know the risk that in 5 years, that rate most likely going to change. It could go down as well, but most likely will go up because of how lower interest rates are currently. But that was a good question.
And identifying kind of which structure you want to go into is kind of based on you. I know lately, and probably a lot of you have been seeing, 15-year loan as low as this, 15-year, and that's wonderful. But the the idea of a 15-year loan is to pay it off quickly. Your profit margin on it, or your amount that you pay each month, like Ruben said, is going to be more costly than your 30-year loan. And that's because it's amortized over an excess of 15 years on the 30-year loan. And you can always pay down your 30-year loan at the same rate as a 15-year loan, but you give yourself the option to pay it down or make the less payment. So if you pay $1,500 a month on a 30-year, you're likely going to pay about $2,200 or something like that on the 15-year. And so you can always pay that down as quickly as you like. There's never a prepayment penalty on residential loans, meaning that if you get a loan for $200,000 on a 30-year loan and you pay it off in 20 years, there's no penalty assessed to you as the borrower for paying that off early. I'm sure that everybody that you did your loan with will just pat you on the back and say thank you, because there's no longer risk associated with your file. So there's never a prepayment penalty there. And I saw a question pop up, is 30 years safer? I'd say the way that it's kind of safer than a 15-year is that if something ever happens with your job, or some kind of, you get injured and you have a lot of medical expenses, you're not subject to paying that higher monthly payment. And with your when looking at your 30-year option, so it does help you stay a little bit stress-free or a little less tight with your finances when you have a lower monthly payment.
Yeah, and the average life of a mortgage on the bank side, not to nerd out too much, but is only about 7 to 9 years, because life happens and things change. I mean, if you think about the last 5 years of your life, how many times you moved, and maybe because rents went up or your job switched part of the town, so you just want to live closer, or you start a family and you realize you don't have enough space, or you get 3 dogs and you realize you can't be taking them up and down the stairs of your condo, so you might want a bigger house. So things do happen. The 30-year is always just safer for that lower payment, but chances of you being in that house for 30 years is very unlikely. Yeah, cool. All right, let's go to the loan process. So the first part is maybe identifying a broker or lender that you trust, or you think you want to go apply for a loan, or just get some expertise advice from. So one easy one would be where your bank accounts are established, would be going to talk to a lender there. The process is the same for any mortgage broker or financial institution for a home loan. So it starts with an application. It's called the 1003 or the URLA, URLA, and it's going to ask you for basic information from your current residence, the time you were there, your job, how much income you earn, how long you've been there. It's minimum of 2 years. If it's less than 2 years, they'll be asking for previous residence or prior employment from there. They'll be asking for account balances on bank accounts. And they'll go through a series of questions. If you filed bankruptcy or any judgments against you, do you plan on living on the home as your primary residence, etc. So it's a very simple application, but it's 4 pages on a legal page. So it looks very intimidating, but when you drill down to it, it's very simple, and it's an easy step-by-step process that any officer would be happy to walk you through. So once you get that, they'll be asking for income documentation and asset verification to verify everything that you put in the application. So if you're saying you're making $18 an hour at X, they'd like to get your last 2 pay stubs and W-2 most likely to verify that you are making that $18 an hour and such, because obviously anything that you put in the application, you're stating to be fact. And same thing, they want to know where your down payment funds are coming from. So if you saved $40,000, $20,000, they like to see the bank account where that $20,000 is, or if it's going to be a gift, to see a gift letter. So after they receive all that information, they'll pull your credit. So going back to establishing credit, they'll see how trustworthy you've been with the other creditors. And if your credit score is sufficient, your ratios look good to move forward. Rule of thumb, debt to income ratio, we look at maybe 45%. And what that is the ratio between your debt and your income. And when we say debt, that's your monthly debt obligations, such as car loan, student loan, rent payments and such. We're not looking at your Netflix subscriptions or Amazon Prime shopping sprees. We're not looking at utilities or cell phone bills because the bank size, it looks, you could do away with a cell phone. I know we couldn't, but without that monthly payment. So we're just looking at more of the bigger debt obligations there. And after that, then the bank will give you, before you even talk about rates or programs, the bank will issue you a pre-approval letter for X amount. Nice cut, by the way, Sam. Go Rams. So they'll give you a letter for how much you qualify, or maybe it's a discussion you have because you might qualify for X amount and you go shopping for that, but that would be your entire monthly checks to go to that house payment, where you have to sit down and be realistic with yourself and say, well, I don't want to be house poor and eat ramen noodles for the next 3 years. So you might have to dial it back, but that'd be an individual decision on that basis. And with that letter, you could go find a realtor and go shopping. But before we talk about realtors, do you want anything to add with the loan process? Sorry, I hogged up the time.
Yeah, no, that's all right. I mean, Ruben pretty much hit it all on the right points there. I think the biggest takeaway of that is, you want to partner with somebody that you trust and that and it's always okay to go and look and ask questions to multiple different lenders, whether that's at banks or brokerages. And I know we've been saying like a broker or brokerage a lot, and so what that is kind of an independent lender that isn't subject to a financial institution such as a bank. All they do is they get a loan originated and then they sell it off in the secondary market, as we discussed. And so you want to find somebody that and that can lead you in the right direction, because there's a lot of people that will just find your kind of top dollar amount and give you that letter and send you on your way. And take what Ruben said into a lot of consideration of, hey, like this is my mortgage payment, if I get this size loan with all your principal, interest, taxes, and insurance payment is going to be, say, $1,500. But he's right. You're not thinking about, your utility payment, your internet payment, phone bill, all of those things. And so that's why you revert back to your budget in that case, and you plug it into what your monthly expenses are. And so say if you had $1,500 payment that's coming up, you put that in your budget, and then now you're going to truly identify if you're able to actually attainably pay that on a monthly basis, with giving yourself enough cushion if anything happens. And by anything happening, I mean, you get put out of work, or you get sick and you can't go to work, or or you get hit by a bus. That's a common term along the bank. Something happens to somebody, right? And so you want to make sure that you're in a good situation and being comfortable with the purchase and that payment. And so if there's any questions, I know I saw someone's in a question about a Canvas Credit Union, Fitzsimmons. What was that question, Sam?
They were asking if a credit union is more ideal.
Do you want to take this?
Or
Sure.
maybe just if they're ideal lenders in general.
Yeah, so credit unions they're essentially a bank. The way they were established back in the day, because banks couldn't operate outside of different states, or maybe even within different counties in a state. So credit unions were established for people's employees to be able to cash a check and have a banking relationship. So that's why a lot of them are referred to members. So think about that. I think there's a Coors Credit Union because of the amount of employees that they've had back in the day, where a lot of people weren't going to banks. They created their own little bank, and that's why you had to be a member of them. Now they're pretty much open to anybody, where there's a teachers credit union. Before it was only teachers. Now it's if you ever had a teacher in your life, you could open an account there at Teachers Credit Union. But they're the exact same thing. They pay less taxes, but that's a whole different, that's another level there. Again, sorry for nerding out a little bit. But banks and credit unions, you could look at them as the same.
So there wouldn't be any pros to using a credit union instead of a traditional bank.
Correct. They would be, yeah, they the people say that the rates are slightly lower, and that could have been the
Mm.
case with maybe car loans at one point.
Mhm.
But now that all the credit unions have combined to be one large credit union, so a lot of them, even with different names, operate with the same entity or
Oh.
umbrella. So they're all about the same.
Oh, okay. Interesting.
It might take a little longer to get your loan, but
That's actually a question that I have,
Yeah.
if it's okay. Someone asked recently, another student, but if they make some kind of purchase or like a big purchase before getting a home or getting approved or whatever, does that impact them negatively?
What kind of purchase? And is it on like your credit card, or is it just out of your bank account?
I think for them, they were thinking of buying a car.
Okay. So yeah, when
Yeah.
you go and you every time you get your credit pulled, it's called an inquiry, and it goes on your credit report. And there's an average number of inquiries per year, and I think it's three. We'll call it three. There's 3 or 4 or something like that. And so the more times you get your credit pulled by different lenders, will affect your credit kind of negatively. It's not a huge dip, maybe about 5 points or so off your credit score. But by establishing that car loan, that will impact your ability to borrow in the terms of how much you can get qualified for. So by adding a new monthly expense, it will reduce your buying power, because your monthly payment that you can afford now in the bank's eyes is going to be less. Because you have to pay this 300, 200, whatever dollar car loan, in addition to what you were already paying. And so it could hinder your ability to borrow a higher dollar amount. It won't necessarily kill your whole opportunity to purchase a home, but it will hinder your buying power, as well as if you put any money down for the car, then that takes away your cash that you're going to use to purchase the home.
And one thing I didn't touch on was the length or the timeline. So the pre-approval process could last as little as 2 days, maybe a week, depending on the institution, as long as you cooperate and get all the information they need. Once you find a house, that's probably the most difficult and timely thing in this market here in Denver, is actually finding a home at the price point that you want, that fits all your needs and wants. But once you have an executed contract, from once you sign the contract to closing, you're looking at about anywhere from 35 to 45 days. So in those 45 days, you don't want to hurt the process of that pre-approval, because that pre-approval was based on the information that you provided at the time of application. If anything changes within those 45 days, the bank could revoke that pre-approval, because like Zizi said, you went and bought a truck, now you have a $500 payment that you didn't have before. So that voids that approval.
Thank you.
Any other questions?
There was a question earlier about, are there loans options that are longer than 30 years?
Not particularly,
No. Back before the first or the housing crash, you could find a 40-year loan. But if you think about it, yeah, your payments be less, but the amount of interest you'd be paying would be pretty crazy. So they got rid of those. So 30 years is the maximum.
And I would say, just if any of you out there are looking to purchase a car before you buy a house, there's always a bus to ride. The light rail is great here in Colorado. You can bike to work. If you're really interested in getting a house, don't go all out on a car and kind of hinder your ability to do so. That's just my tip there. Take it for a grain of salt, but get what you want as your priority and make that happen. You can always purchase a house and get roommates, and they could pay for most of your mortgage, and then you can go out and buy your car. And so there's a very great light rail down the street from here.
Yeah, I mean, buying a home, I mean, it takes a lot of discipline and saving that money. Like I said, I went through, my path is a little different because of grad school and living in different states, but you have to be committed to your budget and be realistic with your budget. I mean, on one spectrum is saying, I'm going to save every penny I get. Well, that's not realistic because things happen. Or be realistic with yourself because things do change. Know that, oh, I like snowboarding, so my winter months, I'm not going to be able to save as much as I do in the summer months. So kind of plan that out and think about that because obviously you still want a quality of life and you could budget 3 ski trips for 1 month or whatnot. So, and in the summer you're a hiker, so that's free. So know that your budget could change from month to month, from check to check. So it's not set in stone because you're the one creating it.
That's a great point. All right.
We saw one more question I didn't catch. My partner and I, but then it kind of dotted it out.
It says, my partner and I want to buy a home, but my credit is much higher. However, he makes more income. Should we apply for the loan together or separately?
Well, that's a very good question. I would, depending on how different so I guess anything above 740 credit score is considered excellent in the minds of financial institutions. So if he or she's at 800 and you're at 600, you might want to discuss those different options. But if you're all pretty reasonable, you want the most income, depending on what you want to qualify to, I guess. So if you need both incomes, you have no choice but to apply together. If your partner if your credit score is significantly lower because of late pays and collections and such, and your partner's income can pay for the house and get qualified for the type of home that you like, that's one situation where you would apply separately. But if you need both incomes, it'd be highly recommended to apply together.
And that question can simply be answered by speaking with a loan officer or a lender and expressing the situation, because then they can go and do like an initial quick underwrite to let you know how both options play out. And they should be able to tell you kind of what the difference in payment would be due to your credit score or such. And so that's where you would want to start with that first. It kind of depends on your situation and what your hopes and dreams are to make kind of the right decision there.
Do lenders charge to do that check for you?
Pre-approval?
Yeah, and to give advice about whether you should use just your income or your partner's as well.
No.
Yeah, and if they want to charge you, go to a different person.
You can call Ruben or I, and we'll be happy to sit down and discuss that with you. The only thing is that technically, I don't believe we're able to give you kind of the advice of which route to take or what to do. And you got to just understand that whatever's being said to you, you got to make that decision on how you want to go. There's definitely pros and cons that will kind of be mentioned, but ultimately you're the borrower and you have the deciding factor in that resolution there.
Yeah, and that's a good point too, is just, again, finding that trustworthy lender and realtor where you could feel comfortable and be upfront with them as well, because a lot of my customers that I've started off with, I won't pull credit because, again, that's an inquiry that could negatively impact their credit. But just having a discussion with them and an open and honest discussion, because there's no sense in lying to me of how much credit card debt you have, because when we pull credit, we're going to see it. So it's better just to be upfront. We're not judging by any means, but if you're hiding child support and then it comes out that you're paying $800 in child support, or on the other end receiving it, that could help you out too. So it's just best, it's always confidential. We don't judge by any means, and we just want to help you be an advisor to help you make the best decision for you and your family.
What are your thoughts of buying a home right now? Is that your question?
Yeah.
Yeah, I mean, I think it's kind of, if that's what somebody's looking to do and starting the process, I would kind of switch the question a little bit and just state that now's the time to start talking about it and to start gaining as much information as possible to identify kind of if you're ready to buy a home. And so should you buy a house right now if you can and want to and have the ability to do so? And then then why not, right? And so there is kind of a seasonality with buying a home as well. And Ruben, you can chime into this if you'd like, but kind of the busier time of when there's a lot of transactions going on and we kind of see a hike in price does come in the kind of summer times. And then it kind of settles down in the winter times. And so we're kind of entering the summer times right now, or the spring summer area. And so there could be a more competitive market, meaning the activity is higher and going around. And I know we've seen a lot of homes recently that people are trying to purchase. They put an offer in for the asking price of the home for what somebody wants to sell it for. And it's been going couple $1,000s up, 10, 20,000 at sometimes above asking price. And that's just the competitive nature of the market that we live in here in Denver. And so that's why I hindered back to my first part of that was now's the time to start talking about that and informing yourself of what the buying process is, knowing what you're qualified for, knowing what that payment assessment will do to your budget, and making sure that all those factors are in line. So that way, when you find a house, you can shoot for it and try to be one of the first ones in there to see if you can get into contract to purchase the home. It's never a bad time to buy because you never know what the future holds, and you can't really look, oh, yesterday this was that price, now it's this price, right? You'll never know what the future really holds. You only know what your goals are and aspirations.
That's great advice. Before I get to the next question, I want to ask a follow-up, but there's a lot of people who've been talking about, is it safe to buy a home with the economy right now? What are your thoughts with, maybe I have the money, but also what is going to happen to the home market and things like that?
So this kind of, before it was, I think, a Denver problem. That's not even a problem, I guess, a Denver issue we had 5-6 years ago where we were booming and people were moving over here. And I felt like we were not necessarily in a financial bubble, but in just a bubble where, because we were in the real estate market here and we were just seeing prices rise and this is crazy. But now it seems like the entire US's home prices have gone up. And like Zizi said, it's more of a personal choice. The biggest way or the quickest, I guess, way to build your wealth is buying a home. I mean, because that's equity because you're not buying it at 100% finance, you're going to have equity in there. So with your down payment, most people's wealth is from real estate, whether it's their home or rental property. I would look at each person's industry. I mean, if I owned 3 restaurants right now, I probably would be where I'm at. And even if I could afford a bigger home, I mean, that restaurant and service industry has taken a beating with this pandemic. So I'd be realistic of like, all right, what industry am I in? What industry am I going into? If it's a trade industry, shoot, I mean, the plumbers right now, you can't get, or any contractors, you can't get anybody scheduled because they've been so busy. So if I were one of them in their industries, I'd be pretty confident in buying a home. And you have to think about homes as, you want them to increase in price and gain value, but you also there's always some value that you can't put dollar on, right? So say you've been living in an apartment forever, you have a dog, it's loud, it's noisy upstairs, downstairs, people are loud, banging stuff. You're always taking your dog out to for walks or do their thing. But so there's a point where you say, yeah, I'm going to move out to the burbs because I want my peace and quiet and I want a yard for my dog, or I'm thinking of starting a family. So there's a dollar value that you can't put on that stuff, where quality of life is bigger than how much is my house going to appreciate in the next year kind of thing.
I'd also echo off of that too. I have kind of this conversation with my brother all the time as well. And I kind of tell him, he's like, well, what if I go in, he's looking for his first home right now. And he's like, well, what if I buy this house right now and then the price value for homes kind of drops after I purchase it? And he's like, then I'm gonna lose money and all this stuff. And you're not losing any money if the price of the value drops. You're going kind of under the amount of equity that you have. And we're saying equity a lot. That means the difference between the value of your home and the loan amount that you have is considered the equity portion. And so just understand that you never lose money on it if until you sell it, if that was the case. And as long as you can make your monthly payment's never going to change because the value fluctuates unless you decide to do a refinance with the loan. And so, as Ruben said, if you're comfortable in your industry and you're confident that your job is pretty secure and you're good at what you're doing, and always have that back off, if I leave this job, I know I can go somewhere else because I have this kind of expertise. Then you shouldn't be scared of purchasing a home and letting the value kind of drop a little bit. As we've seen year over year and like all the kind of crises that have happened, home values always bounce back. And so it's okay to see kind of a negative appreciation for 1 year after we've had almost 10 years of straight appreciation going up. It's never going to stay that way. And you got to understand that it's a kind of a cycle where it will kind of fall back down, but then the price will come back up. And you don't lose any money until you sell it. Your loan won't change. The bank's not going to come back at you and say, hey, your home value went down $50,000. You need to now give us $50,000 to make you not underwater on the mortgage. We're not going to do that because have already qualified you based off of your income, not of the value of the house necessarily, but your income to service that payment.
Yeah, and it's kind of like stocks, right? So you buy Tesla stock, you bought it last year, it's increased so much, but that's really just on paper, right? It's an unrealized gain because until you sell it and you realize that gain or that loss, it's on paper for now. So good point, Zizi.
Thank you. Those were really great points and great advice so far. Thank you. The next question that we have is, I want to get my credit score prior to applying for a home loan. Which of the credit agencies should I pull from that is most reliable?
So there are 3 credit agencies, and they allow you to pull your credit once for free every year from each one of them. The 3 are Experian, Equifax, and TransUnion. And so if you log on to their site, they'll give you 1 credit report a year for free.
I also use Credit Karma. There's people have mixed feelings about it, but I feel like it's done justice for me to get me in kind of that ballpark. And understand every time you look at your credit, whether it's straight through the you like Credit Karma, Sam? Every time you pull your credit, it's probably going to be different from what you saw previously anyways. Sometimes for better, sometimes for a little bit worse than what you saw. But the important thing that I like about Credit Karma is that it's free to see kind of every outstanding balance that you hold underneath your social or your tax ID number. And that helps you understand what's on there. It tells you your utilization of your credit cards. And then it also tells you if you've had any missed payments, anything like that. And then kind of gives you 2 scores. I think it's TransUnion and is it Equifax on there or Experian? I think it's Equifax. And so you can see between the 2 numbers there. And when we pull credit, we pull all 3 of those. And then it kind of gives us a larger report than what you would get on Credit Karma. But if you want to kind of identify your scores and kind of get a printed copy of that, then using one of the 3 bureaus that Ruben mentioned, the credit TransUnion, Experian, and Equifax, then you do get 1 free pull for every 12-month cycle.
Yeah, and the biggest takeaway when looking at your credit is obviously that everything's being reported accurately, because it might be a month or 2 off. So if you had a little balance on a credit card, know that it might be a little off because it might be a month delayed. But the biggest thing are there any collections or fraudulent activity? The biggest kind of cell phone collections, because some people don't pay bills out of principle and go to a different provider. They thought it was clean and done, but then come to find out there's been a $90 collection hurting their credit for the last 5 years. Or medical collections also when if you, I just having a couple customers where they go to a doctor and they don't get, or they miss a bill because of all the bills that they get. And it's literally $50 that's been hurting their credit because it's been outstanding for multiple years. And that was just a matter of, they just didn't know that they were being billed or had that bill outstanding. So that's probably the biggest takeaway when looking at your credit report.
Reports fall after 7 years. I don't think they'd be.
So there was a comment or question. Was it medical bills?
Yes, it says medical collections fall off the report after 7 years in Colorado, correct?
I'm not familiar with that. I've seen them be on there for more than 7 years. So usually bankruptcies are the ones that fall off or quote unquote or discharged after 7 years. But I'm not familiar with that. We'll have to get back to you on that one.
I think it's 7 through 10 years, depending on the company.
Okay. We'll have to get back to you guys on that, Sam.
Okay, yeah, I'll copy it down so that we can talk about it next time.
Thank you.
Yeah. I was wondering if you both could talk about maybe your own personal hustle that you went through to get your first home.
Well, Zizi's you will have to be here for another 2 hours.
Well, yeah, I'll talk. So, yeah, just kind of long story short. I mean, I started working at the bank full time after graduating from school, and then kind of just had fun for a while, and then I found myself in kind of a little bit of debt that I needed to pay off in credit cards. And so in order to get kind of my down payment funds and closing costs in order, as well as kind of pay off a lot of my debt in order to qualify for the house or for my condo, I worked a bunch and I made my budget. That's when I first kind of established my budget and understood kind of what the time frame was. And so I worked kind of night and day in trying to figure out how to make it happen. And what it took was just kind of, the determination and understanding and that discipline that we talk about with understanding what we wanted. And so every time I wake up, go to work, and then my paycheck comes in, I knew exactly where my paycheck was going to be going, to which bills and to which category of my budget, essentially, for every 2 Fridays, it was going there. On the weekends, I worked down in Parker at Big Jim's Barbecue and Ribs. It's where you put the South in your mouth. If you're ever down in Parker, go ahead and get some homemade barbecue. We got brisket, ribs, chicken, sausage, and pork. And so I don't do that anymore, but I did do that every Saturday, Sunday. Occasionally when I had the day off at the bank on Friday, I'd go and work there on Fridays. And so I put in a lot of hours and a lot of work into trying to source that down payment. And then to pay off, some of my credits that needed to get paid off for my ability to purchase the home. And luckily, around me with as I was just kind of getting started at the bank, and I had done a few mortgages for people at that time, but I wasn't sure. I have PMI myself, so I put down. I think it ended up being about 5% down to get the numbers to work for my purchase of the condo. And I had people like Ruben and my other coworkers to kind of discuss things. Oh, what if I did this or this, and so it was kind of a crazy process. And there was a lot of rough times where I didn't look like it was going to happen, but that just made me work a little bit harder, on my days off. I still went into work to get some money. And then now I'm here. And so I made that purchase happen, and I never have to work like that again right now, and I can just look at the place and be happy. So
my journey is not as exciting as cool as Zizi's, but since I've been all over the country, I lived in Indiana. I had enough money to purchase a house there, but since I'm from West Texas and a lot of friends are here in Colorado, I didn't want to be stuck in Indiana by any means, because it is a large purchase. It's a commitment, and I didn't see myself there long term. So after floating around, I went back home to Texas after a couple stints here or San Francisco. I was laid off, and so that kind of put any plans that I had kind of got crumbled there for a bit. So I came back up here, started working in banking again to kind of establish again that bank account. to where I could have enough for a down payment. And luckily for First Bank, I was able to put down, I think, 3.5% or so, but the bank had a program for employees that I was able to utilize for that. And also, I mean, there is a place for renting because I always had a roommate, and it worked for what I needed at the time because my rent was so low, splitting utilities, everything down the middle, rent down the middle. I still liked my disposable income. So you have to make a decision of, all right, where do I want to be? Where do I want to go? Am I ready for this big commitment? Because it is a big commitment. But I'm happy I did it, and it's never too late. And there's never a timeline. I mean, you could probably follow all the Instagram people and Facebook, and there's no timeline. It's up to whoever the individual is and their plans.
Thank you for sharing. I think that's awesome. And Zizi, I didn't know that you were doing 2 jobs, so that's really cool for you to share and talk about. Because I think
he barely does one here at the bank.
No, but I think that's so relatable because for me, I grew up in a low-income family, and nobody in my family has ever bought a house. I'm the first person. And so I always assumed like people who bought homes were people who were well off and already had a lot of family wealth to go on, or their parents helping them out and stuff like that. And I also assumed I wouldn't have to work 2 jobs when I graduated from college, but I did. And I also did a lot to make sure my credit was good, and it worked out. But I think that's something that I at least didn't know. And I don't know if the students on the call have that same assumption that I did, but I think knowing that you do have to work really hard to make it happen, and it is normal. There are more people who do that than what we think of, like not just people who are well off. There's the people who have to put in 2 jobs for a while until you can get your credit up or whatever it is to be able to afford, and that's part of your journey. So Ruben, your story is also really great because, some of our students, have worked full-time jobs and are back in school, and have had a lot of life happen that may have prevented them from buying a home in the timeline that they wanted. So it's cool to hear different stories about how you've made it possible.
Right. And one thing too, I mean, after you buy your house, I mean, things could change and you have opportunities. Like Zizi said, his first condo, he had a roommate and to help pay off his mortgage. When I bought my place, I found this travel nurse site. So I had a travel nurse there for 2 months, and that offset pretty much one payment. Do I want a full-time roommate? No, but do I like the extra income? Absolutely. So there are different opportunities, or Airbnb. Yeah. I mean, if you have family in town and you could rent out your place for a weekend or a week or so for people visiting, and you could stay at your parents' or family member's house, that'd be an opportunity. You could just get creative. Yeah, get creative.
That's really creative.
Yeah, get creative and take a risk. I mean, owning a home is pretty gratifying and satisfying.
Yeah, that's awesome. Well, I see that we have 5 minutes left. So if there's any other questions, feel free to put them in the chat, and we'll be here again on Wednesday the same time. And I think it's the same Zoom link. So if you want to click that link, share with a friend, you're welcome to. And we'll just kind of hang out and see if there's more questions. But if not, feel free to start logging off. Thank you all.
No, thanks for the opportunity, Sam.
Yeah,
thank you so much. We'll see you all again on Wednesday.